right, well, welcome everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host tonight for Zoom at 8. And as you know, I work for Old Capital Lending. We are a premier provider of debt, not only for multifamily, but for many other of the asset classes. And you know what? We are a relationship lender. So if you're looking at a deal and you need certainly the debt, but you're looking for a sponsor, an LP, an attorney, a property manager, or even an insurance broker, come to me, I'll set you up. Without any more delay, I want to introduce you to Mauricio Rauld. He was one of our first to join us before we took it out nationally. We were always with the Michael Blanc closed group, but now we're out. And Mauricio was so gracious with his time to share. He is the founder and CEO of Premier Law Group. He has more than 20 years of securities experience. Mauricio is a premier syndication attorney in the country, focusing exclusively on syndications for real estate investors. Mauricio has been recognized as one of the top California attorneys under 40. You're under 40 years old, by Super Lawyers magazine.
Not anymore.
Well, we got to update that. As an educator at heart, Mauricio regularly travels around the country speaking at to real estate investors on how the legal piece fits into all of the syndication puzzle, and he helps you stay out of jail. A constant on the real estate investing podcast circuit, Mauricio is a regular contributor to the Real Estate Guys radio show, the Lifetime Cash Flow Through Real Estate with Rod Khleif, the Ken McElroy podcast, and he's also launching his own coming up 2020. Stay tuned. We're almost done with 2020, my friend. He is a graduate of the University of California at Berkeley. I hope you kept your underpants on. And Mauricio lives in Southern California with his let's see, he has a beautiful wife, and she is a Miss America, and his two angels, Adelina? Is that
Adelina and Alessandra, yeah.
Okay, there you go. So he actually now lives closer to me, only 3 exits closer. Okay. Well, anyway, welcome, Mauricio, to Zoom at 8. It's always a pleasure. How are you doing?
I'm doing good. Like as I mentioned before, well, first of all, thanks for everyone for coming and showing up. I always say this, but I'm always shocked at the amount of people that show up to listen to a lawyer. So we'll make sure it's worth your while, but a little flustered. You know, we just, as Julie said, we moved about 10 days ago. It was like we moved on a weekend, yep. And so, you know, my office, I try to make it a little bit tidy for these Zoom calls, but if I would have turned the camera just a tad, you'll just see full of boxes and stuff like that. But I'm excited to be in the new house and just excited to be here. So it's interesting. I think the plan was for us to talk about sort of all of these new SEC regs and guidelines that came out, and there's actually a lot of them. It just occurred to me, there was just, I think this was after we got it on the calendar, but just recently there was another new, which is probably the most exciting of all of them, which I don't know, I haven't quite figured out which one we're going to start with, but there's really 3 sets of regs that have come out this year, or not, I shouldn't say come out, have either been proposed or have come through, and they're all interesting. So I don't know if you have a preference I don't know if you even know what all 3 of them are, so I'm just going to randomly pick one, and let's go with the one that's done. Let's do that. Let's start with the one that's done. And so literally I think 2 months ago to the day, or it may have been the 26th, because I think I had it down as October 26th as a 60-day period. But they finally got around, the SEC finally got around to updating the accredited investor definitions. That's the one that most people have been talking about before this last one that came out. So let's talk about that, because that either became effective yesterday or today, or is about to become effective. It's technically 60 days from the date it gets published in the Federal Register, which we don't always know exactly when that happens. But I know the rule came out in August 26th, so I figured 60 days from now would be October 26th, which was yesterday. But they've actually been talking about it for a while. So let me just set the stage for you guys. So just backtracking again, I know that I think there were some newbies in the room, so I want to respect that. Depending on when you're a syndicator, when you're raising money, we pick exemptions to registration, because the general rule is we have to register these securities, these syndications, with the SEC, which we don't really want to do. Actually, we never really want to do that. And so we're always looking for exemptions. And one of the big pivot points, or one of the most important factors of these exemptions, is whether your investors are accredited or not, because sometimes you're allowed to accept accredited investors and sometimes you're not allowed to accept accredited investors. So whether one is accredited or not is a big deal. And typically it's based on, not typically, up until now, it's been based on income or net worth. It's been on your financials, right? So an accredited investor, just to make sure everybody's on the same page, it's anybody who has $1 million of net worth, excluding their primary residence, or has earned $200,000 the last couple of years, meaning 18 and 19, and then have a reasonable expectation of earning that much or more this year. And if you combine it with your spouse, that goes up to $300,000. And there's always been this debate because, is money really the best way to determine if somebody should be eligible to invest in a deal, right? I mean, everybody, when we were doing these lives, I would always ask people, raise your hand if you know a really, really rich person who is the dumbest person that you've ever met, right? There's lots of rich people that are morons, a lot of millionaires that don't know the first thing about money. And by the same extent, you've got people of very modest means who are outsmart all of us in this room combined. So there's always been this debate as to whether that should be the thing. And there's always been this conversation about maybe there should be some kind of an exam that people could take and kind of show their smarts, I guess, or take a course or whatever. And the SEC back in December, I'll give you an idea of how long these things take, back in December of last year, released a proposed rule that kind of went through these ideas of updating the rules, because they really hadn't been updated for a while. I mean, the last update we got was the net worth requirement. They added that personal resident exclusion because I'm here in Southern California. Everybody in California back in 2007, 2008, before the crisis, they were all accredited because their house was worth $1 bazillion, right? Their house had gone up in value. So everybody in California was accredited because of their house. So they took that away. But they finally came back and said, look, that might be a little antiquated. We want to give investors, passive investors, the opportunity to become accredited, even though they may not qualify from an income standpoint. And the short of it is, they ended up passing like 90% of the proposed rules ended up being the final rule. And again, the final rule took, 8 months to get through from the proposed stage to the final. It gives you a good timeline. So when we talk about the other ones that are coming down the pipe, essentially they said, look, they really made two big changes. The main one was we're going to come up with some certification, some certification programs, right? We're going to license institutions. And by the way, we don't know what any of this looks like. So that's kind of my big knock on this current rule. We're going to give licenses to certain institutions, certain groups, and they're going to give a course. You're going to be able to go take a course with these guys. And we don't know if it's a weekend course, if it's a seminar, if it's a 6-month deal. We don't have any of those details. But the idea was you would take this course, you would pass an exam, and then you would get certified. And now once you become certified, you are now considered an accredited investor. And the idea is that they've set the ground rules for that, or the foundation for that, but they haven't gotten around yet to designating people as, people who can actually put these courses together. So that's the piece that's kind of still missing, which is why I'm not super excited about the rule, because I don't think it really affects anybody right now, even though the rule has passed. The only thing that really changed as of today is if you're an investment advisor. So if you have a Series 7, a Series 65, and a Series 82, any of those 3 licenses, because they took an exam, they passed an exam, and they have a certification for that, they've already included those people in. So if you're one of those 3 license holders and you were not accredited before, now you suddenly have become accredited. And the idea is that any minute now, any day, I don't know exactly how they're going to roll that out, but they're going to start designating institutions or whatever to be able to give these courses. And like I said, we just don't have any details on that. But to me, it kind of opened the door, and we're going to be a lot more excited about this over the next, I don't know, it could be next weekend, but in the next couple of months, I guess, or maybe at the beginning of next year, we'll find out. But it's going to be interesting, whether it actually makes a big difference or not, I don't know. Obviously, if you're actively, I know there's a couple of you right now that are actively raising capital. If you talk to somebody and they're non-accredited, are they really going to go run out? Well, I'm not accredited. Hold on a minute. Let me go take this exam, or let me go take this course, and I'll be back in a month or two with my certification. That's probably not going to happen, to be honest with you. I think it's more if you're a serial investor and you'd like to have access to some of these deals, then you'd go to the trouble of taking that. But that's really the main update. There was another update that people talk about, which I don't think really is relevant to what we do, but I'll discuss it because in case there's any questions, I'm happy to answer questions about it. But there's a knowledgeable employee exemption that they also brought out, but it really is geared to existing companies. So if you're for example, if you're a startup company, think of like Facebook, before it was public, right? You had a private company. They did, Series A, Series B, and now you want to go raise a bunch of capital for the next stage. And you have an employee in-house or a couple of employees that are really involved in the equity raise and that whole, courting investors and just kind of involved in that process. They're super knowledgeable about what's going on. The SEC is saying, okay, well, if you're a knowledgeable employee, that you would qualify as an accredited investor as well. The reason I don't think it really applies to us is because for us to get technical, the issuer, which is the company that's actually selling the securities, it's always a brand new company. You don't have any, the issuer doesn't have any employees in our world, right? Because we're creating brand new companies because we're going to go buy real estate, right? Even your own GPs, most of you, not all of you, because some of you guys do have employees, but even the GPs don't really have employees. There's just an LLC that you created for yourself. Maybe there's another partner, so there's two of you, but it's rare, not unheard of, but it's rare for you to have actually a huge team and have actually employees in there. But that still would be an employee of the GP. The GP isn't the one actually raising money for themselves. They're raising money on behalf of a new company that doesn't have any employees. So I don't think that's going to be the road for us. I think the road for us is going to be when it comes down the pipe. What is it going to look like? Hopefully it's a weekend. Hopefully it's a 2-day seminar or a 3-day online course or something like that you can just kind of cram through it, take an exam, and then come out the end of it with a license, with a certification. You're good to go. Because if it's anything like any of the other certifications where it might be a 6-month process or a semester long or something, that's probably going to defeat the purpose. My guess is going to be you're just going to take an exam and you just have to go study for it. Is kind of what I'm hoping is going to come out, but I don't know if that's true or not. So anyway, that's kind of the one rule that's already out there, which a lot of people were talking about a couple weeks ago. Well, actually a couple months ago, until 2 weeks ago, where out of the blue, we got a really exciting development. So I'm going to go with this one next, because this one's the one I'm really pumped about. And this is the one that's really going to affect all of you guys if in fact it passes. And again, just to be, before everybody gets super excited, all we have right now is literally kind of a press release from the SEC. It's almost like, it's a little bit more than this. I'm kind of exaggerating here, but it's almost like, we have this idea. Let me throw it out there and let's see what sticks. It's a little bit more formal than that, but they came out with this idea. Again, let me just backtrack and let me frame it for you guys. As you may or may not know, and I've talked about this for the last couple of years now, and I've almost it's like a broken record for me. And those of you who've worked with me and who've talked to me before know I'm pretty aggro about this. You can't pay money raisers right now, right? So if somebody comes to you, if you're a syndicate and you're raising money, and somebody comes to you and says, let me give you an example. Julie comes to you and says, hey, Mauricio, I know you're raising a bunch of money. You need a couple more money. I've got a couple of people I can send you. I'm going to send you these 5 people. Just pay me 5% or 2%, or just pay me as I get you those referrals. Or another way that most people do it, which is more common, is they'll just bring them in as kind of as a co-GP into the deal, even though they're not really doing anything. They're just there to raise money. And that's become an issue lately, because you can't do that unless you're a licensed broker dealer, and that's a FINRA license. Forget it. You're not going to get a FINRA license. It takes forever and it costs a lot of money, and then you're under these really strict regulatory things. And so, you're not going to become a broker dealer. So most people don't use broker dealers, but this is a prevalent thing that's been going on now for a long time. And over the last, I would say, 8 to 12 months, a lot of high-profile syndicators are starting to get, I want to say nailed, I'm going to say investigated, for lack of a better word, for the SEC. I've actually heard, just literally last week, I heard that one of the first ones that came out some of the players there have been settling with the SEC, but those investigations are out there, and they're actually coming after even more people than the originals. And not surprisingly, they're mostly people who are more public, because obviously they want to kind of make examples. I mean, if you have a presence online, or you're out there marketing these things, and you have a podcast, or you have some kind of an audience, and obviously I always thought those were the people that were more risk. So there's this thing going on, but the challenge is you can't really hire a broker to raise money for you, because brokers don't get out of bed for less than 25, 50 million bucks. Like, they're not going to go help you raise $1 million, $2 million, $5 million. It just doesn't work. And so there's this gap. And there's a long-winded answer to say there's this gap. And out of nowhere, the SEC came out and said, we recognize this problem, we want to fix it. And they've come out with proposed rules that will allow you to pay people to raise money for you. So everything I've been talking about in my ebook that I have, and the videos I've done, hopefully that'll be updated here pretty soon to say, forget about that video I did a year ago or 2 years ago, or let me update my book. Let's go. So right now, the way it's working is you can only do it with accredited investors. So that's kind of your first big limitation, right? So the two big limitations, let me just get to the top, is you can only do it with accredited investors, and you already have to know the people. You can't go start marketing and doing ads and trying to find new people to then. Julie can't go out there and start marketing and running Facebook ads and going on podcasts and getting new people in and then giving them to Mauricio and getting a commission. That's not going to work. She's going to have to already know these people. She's going to have, I presume it's going to be similar to having a pre-existing substantive relationship kind of standard. Again, we don't know, but that's my best guess. So here's a great example. Julie's putting together this group, and then she's got a group of maybe 60, 100 she knows well. She's met people, and then she's like, hey, Mauricio, so-and-so's got some money. They're looking to invest it. I know you've got a deal. Let me put you guys together, and if you can pay me a 5% commission or a 3% commission or whatever agreement we come up with, you're now going to be able to do that according to, as the SEC wants to do. You can actually get paid what we call transaction-based compensation. And the transaction-based compensation up until now has always been the hallmark of broker-dealer activity. So you can never get compensated transaction-based compensation without having a license. So there's no, I refer you someone and then you pay me if they invest. There are some finder rules out there, some states, Texas being one of them, that say, look, if you get paid just for the introduction and you're not involved at all, right, but you just make an introduction and you get paid for that introduction, whether that person invests or not, there's kind of a fine line that you can walk. But under this rule, you will literally be able to take transaction-based compensation so long as it's accredited investors only, so long as you already have a relationship with them, so you're not advertising, so long as it's written. You have to have a written agreement in place, and obviously you've got to, and these are obvious, and then you've got to obviously disclose that relationship. So if you make if Julie makes a referral of an investor to me, the investor needs to know that I'm getting paid, or I'm paying Julie for that referral. But it really is, groundbreaking if it comes through. And they actually acknowledged that this was an issue. It was at a gap, especially for, they call us the small issuers, which we are. I mean, even when we're raising, $5 or $10 million, we're still considered small. I mean, right? JP Morgan has a $26 billion fund. So we're kind of small in relation to all these people. So, but the SEC is starting to recognize that, that us small folks don't have really access to broker dealers, and we need this kind of help to raise capital. And so they've come out with this rule, which I think is interesting. So now, the next steps are there's what we call there's always a comment period. So there's a 30-day comment period. This just literally came out, I think, on the 15th of October. So it's literally been just over 2 weeks. So there's a 30-day comment period where people, like anybody, I could write a letter, you guys can write a letter saying you're in favor of it, you're against it, or maybe some suggestions. And what they'll do is they'll go through all those comments, and then they'll come out with this proposed rule, which is more detailed, it's a really thorough document or paper that they come out with, which typically they also do another comment phase, but then most of the time, 90% of that becomes the final rule. So for example, in the accredited investor thing that we just talked about previously, the proposed rule came out in December of last year. So I don't remember seeing the original press release or whatever, but at some point, I would say in the next, probably not this year, to be honest with you, I would say Q1 of next year, I would expect to see proposed rules, really detailed rules on this proposal based on all the comment letters and things that people are complaining about or saying why it's a good idea, why it's not a good idea, how do we protect the little guy or the little girl, and all that kind of stuff. And then probably end of next year, I would probably see this thing passing. But again, what level of, how much of what we know now is going to stay and change, we don't know. But the concept to me is fascinating. And hopefully it's the first step. I mean, maybe after this, the next step is they expand it to non-accredited investors, and stuff. So I think that was really interesting. Let me just see if I missed anything. Oh, so the other nice thing about, when you're a finder, you're literally making an introduction. Like, you can't be involved at all. You can't be part of the meeting. You can't be, certainly not making any recommendations about it. You're literally saying, Julie, I know you're looking, or so-and-so, I know you're looking for a deal. Julie has one. Let me make an intro. I'm out. Right. And if you get paid $50 for that, or $100 for that, or $1,000 for that intro, whether they invest in that's fine. Under this new proposed rule, you're actually going to be able to be a little bit more involved with the paperwork. So you're going to be able to take the offering docs from the sponsor and actually share those with your contact. You're obviously going to be able to vet the contact and make sure they're qualified. You're going to be able to show them the documents. You're going to be able to talk them through the documents. You're not going to be able to make, obviously, any recommendations about the quality of the deal and all that stuff, but you can walk them through it. And then you can actually participate. You can make the introduction, but you can also participate in that meeting, which is interesting. You cannot participate in the drafting of the docs or be involved in helping put the structure together, which may exclude people who are trying to do it via the joint, the GP version. Because if you're part of the GP, then you're obviously involved in crafting the docs and everything. So that's a little bit unclear. So that may not work as coming in as a co-GP, but to the extent, and it happens all the time, hey, I've got a bunch of investors. I mean, I have a great list. I've spent all this time cultivating my list. I've got 100 people on my list that are really solid investors. I'm happy to do a webinar, talk about your deal, and then if you get 10 investors for $1 million, just give me 5%, and you can collect a nice little $50,000 check or something. So anyway, I thought that was super interesting. I don't know how many, actually, let's do a little poll. How many of you had not heard of that proposed rule? I don't know if it's how well it's been circulating on the social media, but just say yes or no on the chat if you don't mind, so we can get an idea of whether this is just stuff you guys already knew about, or if it's new stuff. Jefferson, no, not really. Good. Yeah, so I don't think too many people. There you go, Kimra. So hey, Tokayo's out there too. So yeah, so I think that's interesting. So if you could literally probably just maybe at the end of this I'll Google it and I'll put a link on the chat so you guys can look. It's literally just a press release at this point. So anyway, so I thought that was interesting. And then there's a third one that, I'll be honest with you, I looked at it. This came out in March, and this was at the beginning of the pandemic. So like, I'm aware of it. I haven't really done a deep dive. The only one that I thought was really interesting, there's a little technicalities in there, but this is a proposed rule now in March. So I would expect this to start, maybe Q1 become final. But the most important one of all, by far, is there's this concept of integration, which I've never really, I need to do a video on this. I don't think I've done an integration video, but it's a really important concept. And that is, if you have two different deals, right, it always comes into, like, let's say you're doing a 506B deal or a 506C deal, and then you want to do another one that's a 506B, and can you do it? Does it count? The SEC will typically integrate, which means it just basically will count two deals as one if they're too close in time and too similar, right? Because you can't think about it. If you're raising money and you can accept 35 non-accredited investors, right? You can't get to 35 and be like, well, let me shut this offering down. Let me start a new offering and let me raise the rest of the money with a new deal, the new offering, even though it's the same property and the same deal, and I'll start my 35 again, right? Even though those are two separate deals and you only had 35 non-accredited in the first one and 15 in the second one, the SEC is going to integrate those together, right? So anytime, and same thing advertising, right? So if you're concerned about advertising and you have two similar deals, maybe one, some people have been trying to get cute with it where they'll be like, well, this deal is the equity, but this one is debt, right? So there's technically two different deals, but they're the same property. They're just structured differently. The question is, are those going to be considered? And maybe one you advertise, one you don't. One's a 506C, one's a 506B. Then the question is, well, will those be integrated, right? Will the SEC look at those as really being one, and therefore when they integrate it, you've violated the advertising rule because they'll combine it. There's a safe harbor of 6 months, which means if you wait 6 months from the time one deal ends and the next deal starts, then the SEC will not integrate those two offerings. For some reason, they're talking about shrinking that number to 1 month, which is huge, because I could see situations where you could almost have a very similar deal. You could literally start raising capital in one deal. Let's say you raise $1 million or $2 million, and then you could stop it and then wait a month, which is, what is it, 30 days, 4 weeks, and then start a second deal, a second syndication in the same deal. So maybe this one's now debt, or maybe the first one was debt and now it's equity. So or the first one was, you know, an 8% pref, kind of the class A model where you're giving an 8% pref and then 60-40, and then you wait a month, and the next one is we're just giving you a straight 10% return. But they're going to be pretty much the same offering, but they're going to be considered two separate just because you waited for 1 month. So I think that's actually pretty interesting, because there's a lot of scenarios that come up where people want to, you know, do a 506B with one and a 506C with the other, but they're too close together. Or maybe the 35 issue comes in. I mean, you could literally, I can see a situation where you're doing a raise, you have a low minimum, $25,000. So you get up, you hit your 35 non-accredited, you could stop, wait a month, and open up a second LLC, but still raising money for that same investment, just maybe a separate class, or maybe now, like I said, it's debt, and that would not be integrated anymore. And you could then start the 35 again, or if you now want to advertise, even though you've done 506B, the first one, you could do it. So I think that's really interesting, and I'll be interested to see if that actually passes. But if it does, I'm expecting that to pass. I would say Q1 of next year. But it's a lot of activities, and I wonder whether it's because they're afraid that you know, the sort of the Republicans may be out, and maybe they're trying to cram everything in before the next administration. I don't know, but there's a lot of activity going on, so it's exciting stuff. I don't know if you have any questions. I think that's it. I mean, I don't know if anybody's got any questions, or that, but that's kind of what I've got in terms of the new proposed rules, or the actual rules that have come out.
Let us open it up to everybody. I see Chris has a question.
Hey, Mauricio, good to see you, buddy.
Good to see you.
Hey, so you know me. I've always got tons of questions for you, and your firms did wonderful things for us on my past deals, so I really appreciate it. Now, I know the rules have changed loosely. Still trying to understand what the heck does all that mean, but I'm still trying to figure out. I think when one of your video, you described a little bit about finder's fee. So how is the new loosely defined rules changes how you can charge a finder's fee, or does it kind of open the door for that?
Well, so two things. Finders are all at the state level. So let's take you're in Texas, so this is a great example. So in Texas, there's a finder's rule, right? So you can get compensated for making the referral. Again, no transaction-based compensation. So you've got to get paid whether that person invests or not. Whether they invest in the deal or not, irrelevant. I made the introduction, you pay me whatever you pay, $1,000, $50,000. The cleanest way to do it would be, for example, hey, you pay me, Chris, you pay me, I've got a list. Why don't you pay me $10,000 and I'll send an email to my 50 people that are really high net worth individuals, and then I'll make intros. And you just pay me $10,000 for that. And if they invest with you, great. But I'm like, I'm not involved. I'm not involved in the conversations that you guys are having. I'm not making any recommendations. I'm not doing it. I'm simply making an introduction, similar to, you know, I've heard the analogy of, you know, when you just, you know, whatever, it's AT&T referral. You get a little $50 referral or you know, credit to your account when you refer a customer. You're obviously not involved in that conversation, right? You're not telling them how great your internet cable is and that how they should, you know, sign up for the service. You're literally I'm like, Chris, I'm using these guys. I think you should talk to them. And then you talk to the person, I'm out. So that's what the finder does. So, but that's only at the state level. There's no equivalent finder at the federal level. So even though you may be in compliance with the Texas laws, there's always been this fear, this hold where it's like, well, there's nothing equivalent at the federal level. So number one, just for finders, okay? But more importantly, this goes a step further. This one does allow you, number one, to get transaction-based compensation, meaning I can get paid if somebody invests. And if they don't invest, I'm not going to get paid. That transaction-based is huge. It's not just an introduction. It's transaction-based. And then number two, it's obviously at the federal level, which is something we don't have. But you can also be involved. Again, you don't want to be making recommendations as to the quality of the, you know, of the pricing. Oh, this is a good deal. It's a bad deal. But you can actually be involved in that relationship. We could literally set up a three-way call. I could be like, Chris, I know you've got a deal. I've got 5 really good buddies of mine who are looking, they've got 500 grand each, right? With the finders, I'd be happy to say, hey, look, here's my introduction. You guys handle it. Now I can actually coordinate a call with you, me, and my investor buddy. I can receive your docs. I can go through the docs with them. I can be a lot more involved. But more importantly, which is the issue that most people have, is that I can get paid if they only invest. If they don't invest, I don't get paid. If they invest, they do get paid. That's the big difference between a finder and a broker, is that transaction-based compensation.
All right, he likes that answer. Anybody else have questions? I mean, this is free. I mean, very important information that will take you to court.
Hey guys, FYI, Mauricio himself charged $350 an hour for consultation. So this is a free hour. Use it.
Who else?
I'm here for you
Who
guys.
else is? Yeah, this is really helpful. Who else is in the house that has a question?
And I don't know if we're limiting it to this. I mean, maybe let's do some questions on the regulations themselves. But if somebody's got a random question, I'm also happy to answer those.
I have a question, Mauricio.
This is Jennifer Barner.
Hey, Jennifer, how are you?
Hi, good. So given that these rulings are not 100% in effect yet, correct? So if I've got a deal that I'm putting together right now and somebody says, hey, I've got like 5 people right now, they're looking to put money into a deal before the end of the year, what's my obligation to be within the rules of, the SEC?
Yeah, so great question. So the finder rules that we just talked about, or the broker, that's not on the table at all, and neither is the integration rules. It's interesting because today is October 27th, so you're right on that cusp. And so we'd have to just, if you literally had an investor, you'd have to have an investor right now who doesn't qualify you'd have to have a deal that you only accept accredited investors, or maybe you're already at 35 non-accredited, so you can't take any more non-accredited. You'd have to have a deal where somebody comes in and says, I don't qualify as an accredited investor based on net worth or income, but I have a Series 7 license. I'm an investment advisor or whatever. And so the question would be then, do I qualify? And the question's literally going to be, we'd have to research, because I don't know the exact date, but we'd have to figure out the day that the rule was on the Federal Register, which I honestly don't know how usually we use the internet to kind of get the rule, whatever the statutes are, but those don't get updated by the second. So I don't know exactly how you actually find the Federal Register. But if you're in that situation, you would have to literally find out when it got on the Federal Register, and then we know 60 days from that date is when you'd be safe. But if you're in the middle of a raise right now and that scenario comes up, you just want to make sure you're researching it. If you wait another week or two, you're probably in the clear, because there's not that much of a delay. I mean, the rule came out October 26th. If it didn't go on there on the 26th, it went on there the 27th or the 28th. So it's not like it takes months for it to get on there. So to be safe, you're probably the easiest one is probably just to hold on, say, hey, you're going to be good. Let's just put you in at the end. Like let's get all the documentation ready to go, but we won't sign everything and don't wire me money until a week before closing. That way it gives us a little bit more time. And if we go into November, I think I'd be pretty comfortable that those 60 days have passed and you're good to go.
Okay, great. Thank you. Appreciate that.
I got a question, Mauricio.
Yep.
This is Andy McMullen. Good to see you.
Hey, how you doing?
Let's say that I'm really insistent that I'm going to bring in some money raisers in addition to having them do some other things. So I'm going to bring in some GP partners in order to help me. And I'm going to do monthly meetings, and I'm going to, make them part of the board. I'm going to give, Julie, Secretary of Investor Relations. How far would I need to go, per SEC guidelines on that and bringing them into the deal? Is it monthly reporting? Is it weekly?
No, it's a great question. Yeah, look, this is a great question, and it's one of the frustrating parts of what we have. And so the rules are pretty the rules are pretty easy to understand. It's just they're just not. They're clear, but they're up for interpretation. So let me just walk through this. I'll spend 3 minutes on it. I could probably spend 3 days on it, but I'll spend 3 minutes on it. So the way you get, I don't want to say get around, it makes it seem like it's nefarious, but the way you comply with the rule is there's an exemption to being a broker, and I'll put it in the chat. It's a 3A4-1. 3A4-1 safe harbor, 3A4-1. And that's basically has all the things that you have to comply with in order to not be considered a broker, right? The first layer is transaction-based compensation. If you get paid transaction-based compensation, end of story, you're done as it stands right now. So if you're giving me a percentage of the GP based on how much money I raise and it's flexible, then that means you're paying me for that, and that's going to be transaction-based. So you're going to be dead in the water. But let's assume you don't do that. Let's assume that we just give you, Mauricio, you're coming in and you're helping me, or I'm alleging you're helping me. You've raised a bunch of money, but I'm going to give you 5% of the GP, not for raising the money, but for actually doing work, right? So then the two next keywords are you have to be doing what's called substantial duties, which is why it's a little bit, vague. Substantial duties, and your primary role, primary meaning more than 50% of your time, the primary role must be conducting those substantial duties, right? So to me, there's three things. One's transaction-based compensation, that's easy. The other one is primary, which is also easy. It's just how much time are you spending raising money and how much time are you doing investor relations or doing whatever else you're doing, right? The uncertainty is, what does substantial duties mean, right? That's a little bit, is like you said, is being the investor relations guy or gal enough? And the answer is it's facts and circumstances. The more involved you are, the better. And the more you're involved with the asset management, meaning as once the deal closes, the more involved you are after the close. If your responsibilities are done once the deal closes, the offering closes, and then you go home and you're just getting paid, that's going to be problematic. The investor relations one is interesting. That's kind of that grayish area. Like I always try and say, look, if you want to be safe, add to those duties. I'll tell you some things that I don't think are going to pass water. Number one, if you're an investor relations person, then you better be a real investor relations person, meaning you're the one who's handling all the phone calls, right? People complain, you're taking the calls, you're preparing the quarterly reports or monthly reports, how are you doing? You're preparing those, probably not the financials directly, but maybe you're the liaison with the CPA or whoever's putting those together. You're helping package that together, you're sending that out, and then you're available to answer questions, right? If you're just simply taking somebody else's report that the sponsor did and emailing it, that's not going to fly, right? And then the other thing that you want to make sure is from a compensation standpoint, that's why it's facts. So to me, it's always been a sliding scale. Like if the raise was $3 million and you brought in $2.5 million of that, and all you're doing is a little bit of work, that's one thing. If you're not doing a lot of work, but you only brought maybe a couple of investors at 50 grand each, that's less of an issue. So you, number one, want to make sure you're doing a lot of work. And number two, you also got to remember, how much does it cost to get an investor relations person, right? If you're getting paid $200,000-300 grand, in shares or whatever to do investor relations, that story's not going to add up either. You can get a full-time investor relations person for 60 grand a year. So why am I paying you 300 grand a year to do investor relations stuff, right? So you just want to be bringing people in doing legitimate work. The issue I have is that a lot of people are trying to fit that round thing in the peg, whatever that saying is, right? Where they really are bringing them in to raise the money. If they couldn't raise the money, they wouldn't be bringing them in. But we're trying to then figure out, well, what role can we give them in order to pass muster? And that's where I think you get dangerous. Look, it doesn't take that many people to do a deal, right? You don't need 7 co-sponsors, right? So the more co-sponsors you have, the more dicey it becomes too. I mean, usually you can do a syndication, depending on the size, with 1 or 2 people, maybe a third person who's boots on the ground. But the more and more people you have, the more suspicious it becomes, especially if they're raising large amounts of money. Because I've got people, and I don't know if anybody was in, this actually came from a Michael Blanc thing. Somebody was saying, look, I've got an engineer who works nights and weekends underwriting for us. And, doesn't spend a lot. He doesn't have all day to work. And he just spends a little bit, like I said, weekends or evenings. And for that, he gets paid 2% of all the deals. That seems reasonable. And if that person suddenly says, hey, I got a buddy of mine who's coming in and he wants to put in 50 grand or 100 grand, that's not going to raise any red flags. But if that same fact pattern happens and that person brings in 90% of the raise, and instead of getting 2% is getting 15% or 20%, it just doesn't start to look good. So, but that's a big frustration is that we don't have much case law or really any case law or no action letters discussing the substantive duties part. It all focuses really on the transaction-based piece. And I've been saying that I'm really hopeful that the investigations that are going on right now hopefully the investigations will give us some clarity Now I'm saying, well, maybe this new rule that comes out kind of makes all that stuff moot, because now you're going to be able to get paid, transaction-based compensation for bringing money raises in.
Hey, Mauricio, it's Jim Biggs. How
Hey,
are
Jim,
you?
how you doing?
I'm great. It's good to see you again. Really appreciate you giving so generously of your time.
I
But
love it.
so I
Appreciate it.
wanted to ask you about some of the new rulings as it applies to Reg CF. And I think kind of the holy grail that we're always pushing the envelope and always challenging you on is can we publicly appeal to investors, and can we appeal to the non-accredited investors? And the answer is pretty much blanket, always been no. But with this new ruling, as it relates to CF, Reg CF, does it change all that? Is this our back door to be able to bring in all of our sophisticated investors and to also still be able to publicly advertise the deal?
Yeah, I mean, you look, there's also Reg A. Don't forget about Reg A. Reg A allows you to advertise and allows you to bring in non-accredited investors. The challenge with Reg A is you have to register. It's not a full-blown registration, so it's a much quicker process, but still it's going to take you 6 to 9 months. It's going to cost you a lot of money, and there's a lot of compliance. But that's the way, if you really want to get advertising and non-accredited, I would look into the Reg A route. Even though you are limited to 10% of their net worth or income, that's one way. The CF, I've never done a CF before. So CF is the new crowdfunding rules. When I say new now, it's been, I don't know, 5 years now probably, since they're maybe not as much, but it's actually called regulated crowdfunding. And that allows, up until recently, and that is part of the proposed rule, which I really just glanced over on the CF piece when it came out in March, just because it doesn't really affect, our business. But in theory, you can raise up to $1 million. That was adjusted for inflation. Now it's like $1 million and some random number. And I think the CF, the proposed rule, was going to try and increase that amount, because the $1 million really wasn't a lot in a 12-month period. So they're really trying to extend that a little bit. You can put it on a portal, just so that everybody knows. You can put your crowdfunding deal on a portal that's either a broker dealer or it's an SEC licensed portal. And you can kind of advertise it, but not really. You can kind of advertise it because you can point to the portal. You can kind of do what we call kind of a tombstone ad. We can say, hey, we're looking to raise $1 million, and it's for an apartment building in Dallas and for 100 units. If you're interested, here's a link. That's about as far as you can go. And then the investor clicks on the link and then goes over to the portal, and now has all the information in the portal. The issues that I face with CF are twofold. One is there's a cost for that portal. The portal isn't free, right? And they're going to end up charging you probably anywhere from 4 to 6% of the raise. So that's one issue. And then you still have the compliance, the attorneys, which I don't do them, but the ones I've done that I've talked to typically charge a little bit more than a Reg D, not as much as a Reg A, but you're still looking at, 15, 20, 25 grand for a CF. So you add that, it's only $1 million. You add that cost to the cost of the portal, and now you're looking at, 10%, cost, whatever, if it's 100 grand to put it together. And then you tend to deal with very small amounts of money. The regulated crowdfunding that really works are people who invest $500, $1,000, really small amounts. And the ones I believe work really well are kind of loans. So, but somebody's got $500 and they want to put $500 somewhere. And so do you really want to deal? Most of my clients don't want to deal with, they don't want to deal with, 1,000 investors that are each put in $500. That's just not something you want to deal with. Now, again, I don't know if there's anything that came out in that rule that I know they're trying to expand that a little bit. But I don't remember if the number was that bigger than $1 million. They may have tried to increase that a little bit, but so I think if you really want to go after non-accredited, Reg A is what you really should look for, but that's a lot more expensive. So you definitely don't want to do that for $1 million raise. You want to be raising 5, 10, maybe put a fund together, maybe do an opportunity fund these days, raise 25 million or something. And that way the cost makes sense. Or, as I talked about in my videos, advertise by kind of, I say advertise, but add value to people on social media, on podcasts, things like this is what Julie's doing. You add value, you get into conversations with people, and you go through those steps, where you take a complete stranger that you got off social media legally and you walk them through those 7 or 8 steps, and then you get to know them, and you've got now a substantive relationship, and then you can offer them a 506B deal after that relationship. That's probably the safest way to go. But those are really those are the 3 options, really. Reg A, Reg CF, which I don't really think it works too well for our business anyway. And then the hard work part, because it takes time, is to establish, online on podcasts and get people off there and start that relationship, which is time consuming. It's not a magic pill, obviously.
Mauricio.
Hold on just a second. Hold on. Bill has had his hand up. So let's get to Bill and then Daryl, and then we're going to be done.
Okay. All right, great.
Because we could go on forever. Mauricio is so generous.
I put my contact in there too, but I mean, feel free to reach out too. We can definitely take some of this offline.
Sure. Thanks for all your input. It's been interesting how this has evolved with the compensation. We all know what's been going on, and maybe it'll be legal now. Anyway, question somewhat off topic. I know attorneys are specialists. How would you recommend that I find a good asset protection attorney?
Well, you're looking at one, but I don't really do it anymore. So if you want to reach out, I can make a couple of intros to some really good people that I tend to send out. I do it for syndication clients now. I do an asset protection review for them, but I gave up that gig about 8 years ago now.
Okay.
But I'm happy that if you want to reach out, I'm happy to put you in contact with the right people.
Great. I'll do that. Thanks.
Yeah.
Super. Okay, Daryl. Daryl's got 2
Yeah.
questions, and we've got about 3 minutes. So go ahead.
Okay, awesome. They're kind of tying together. So in giving equity into deals and stuff like that, because she was saying that, if you have like multiple people in a deal like that, that kind of raises a red flag. So if you've got someone that, you're paying equity to because they brought, a sponsor to a deal, is that an issue? And then what about including like CPAs and attorneys in an equity position in the deals that you're doing?
The second question I can tell you, I'm actually kind of reading it at the same time. You can, there's nothing that prevents, and in fact, it happens a lot more with startups, right? So startups have a lot of legal work they need to come up. They have no money. So instead of the attorney, giving them a huge invoice, they'll just we'll just give you stock options and that's how we'll pay you. And then,
Right.
That's kind of the model. So you can do it. Most attorneys won't do it just because it really, and probably the same for CPAs, it really jacks up your malpractice insurance premiums when you do that, because there's just an inherent kind of thing, and insurance they don't like that, so it'll just jack up your insurance. So, but can you do it? Yes. So that's not a legal problem. The other one you said, can you bring equity for someone who brings a loan sponsor? So yes, I don't know who's waving there, but I'll wave back. Hey, cute little kid over here. Who's that? Evelyn's boy. Yes. So there's nothing. Yes. So if the question is, can you give a key principal, right? Somebody who's signing on the loan, can you compensate that person for signing on the loan? You want to give them a piece of the equity? The answer is absolutely. In fact, that's the common way to do it. And again, the rule is you can't pay people to raise money for you. And I guess maybe you can argue, well, they're bringing in the loan, so is that raising money? But that's not what it really is meant for. But if somebody's simply a KP and they're signing on the dotted line, which as you guys know, you need it, typically the KP, if they're going to charge you at all, because I know sometimes they just want it on their resume, they're going to want some percentage of the deal.
Sure.
And that's negotiable, but that's not uncommon for you to have a KP they're not sponsors of the deal. In fact, I specifically don't even mention them. I don't list them as a sponsor, but they will be an owner, an equity, what I call a Class B member, but they're getting that compensation for the loan, not for raising capital.
Right. The question was, can you compensate somebody that brings a loan sponsor to a deal?
Oh, that's a great question. Can you compensate somebody? I don't know the answer to that. That's a great question. Let me get back to you on that one. That's a great question. Yeah. I've never had that situation pop up. My gut kind of, don't hold me to it. My gut tells me you're okay with that, but let me think through that. And let me. Do I have your info?
And on the attorney and the CPA thing too. Sometimes, with attorney, they'll do what's called an arm's length thing. So when they do the PPM and stuff, they have a fellow attorney actually review it and then submit it under there. So it's not something, because I don't know, just to avoid any like conflicts of interest or
Yeah,
anything.
there's no issues doing it. I just know that it's just in practice they don't like to do it because of the malpractice. You could do it. I mean, I know people who do it. I've even back in the day I used to offer it. I'm like, hey, I know it's a lot of money. Especially on smaller raise, right? If you're trying to raise $300,000, it's like that. You know,
Right.
so, hey, why don't you just give me a piece of the deal? But then the issue came up with the insurance stuff. But let me get
We've
back
even
to
tried it. We've even tried it with commercial loan broker, commercial brokers that are actually, you're working a deal with, to offset commissions. Sometimes they'll take equity in lieu of taking a commission. So there's a lot of ways you
I have
can.
no problem with the getting paid to bring in. I don't think they're money raises if they're just going to sign on the loan. So I think you're fine, but I'd like to dig into it a little bit and get back to you if that's okay.
Yeah, thank you very much.
Thank you, guys. I appreciate everybody being here. And as I said to everybody, there are lots of options to spend your Tuesday night. And so I appreciate you making this a priority, a place that we're learning and networking. So Mauricio, you put your contact in there, right? So thank you for sharing your evening. I so appreciate the information. You're such a help to all of us. So make sure you guys send over your contacts to Mauricio or your opportunities to Mauricio so he can, be of service to you.